Hi everyone, thank you for attending our first home buyers webinar this evening. Just a show of hands, just a little bit of housekeeping I suppose, just to let me know whether you can hear me. There's on your screen, there's a hands up answer to the query, so if I can just ask people to let me know that you can hear me, if I can just have a hands up, which I can see at my end. If we can have a hands up, that would be great. Excellent. I can hear at least there's, or see at least there's a couple of people there. So welcome. Just to give you an idea of who I am, for those of you who don't know me already, my name is Stephanie Cook and I own and operate the Mortgage Choice franchise based in Lane Cove and cover the North Shore area of Sydney. What we'll be going through this evening is just a step-by-step guide in terms of how you arrange finance for your first property, to try to take all the stress and hassle out of doing that yourselves, because it is a fairly daunting process. I understand that. And importantly, there's a sense of urgency, I suppose, at the moment with regard to what's happening with the first home buyer grants and concessions. Some of you may be aware that the stamp duty concessions as we know them are ceasing on the 31st of December. So again, I can see there's more people joining as I'm speaking now. So perhaps just another hands up from people who is aware that the first home buyer concessions on stamp duty are finishing at the end of this year. Hands up. No one. Okay. So therefore this is very, very opportune that we're catching up this evening. We will take just on 30 minutes and we will have a little bit of time for questions at the end, bearing in mind that hopefully you can all hear me, but I can't hear you, so I'll be able to see questions on the screen at the end, which if we've got time we'll go through all of those. So just to give you a little bit of an idea about Mortgage Choice, there are some of you that I know who are listening this evening and some that I don't recognise the names of, so welcome to everyone. To give you a bit of an idea about Mortgage Choice, we deal with about 25 different lenders. They're on your screen at the moment, so that gives you a really good feel for, I suppose, the depth of the different types of lenders and therefore the different loans that we're able to offer to our borrowers. One of the questions that we get asked most often, particularly if the initial contact from someone is over the phone, is how much can I borrow? That's something that we prefer to sort of turn around a little bit by saying, what do you feel comfortable with? So have a little bit of an idea before you do ask that question. It's a very valid question, but before you do ask that question, what is it that you feel comfortable with in terms of repayments? Bearing in mind that interest rates at the moment are pretty low, what do you feel comfortable with in terms of your monthly outgoings, given that you need to factor in all the sorts of things that banks factor in? Obvious ones like income, what is it that you earn, are there any pre-tax deductions, does it include overtime, shift allowance, bonuses, all those sorts of things. What other existing commitments do you have? Do you have a car loan that you will still have when you buy the new property? Current interest rate environment, yes, it's lovely to think that, you know, interest rates may well be on the downhill slide at the moment, whether it's a slide or just a little blip, who knows. But if the interest rates now are around 6%, 6.5%, sorry, it's about 6.5 to perhaps 6.7% would be a good variable rate. There are some fixed rates down around 6% at the moment, but of course you can't think that in the life of a 30-year loan term they're always going to be that low. So think about what the current interest rates are now and what they could be in the future. The type of product that you go with as well makes a big difference in terms of how much you may be able to borrow. In certain cases, banks will allow you to borrow a little bit more if you take some of your loan or all of your loan as a fixed rate, for example. That may or may not be appealing to you, but it can make a difference to the lender's criteria. I can see there's still a few people joining now, so I apologise if I've already started, but we will be contacting each of you after the sessions. So if there are any things that you've missed, we will be also recording this and putting it up on a blog, as long as our technology allows us to do that. So other things that are important, of course, the number of children that you may have, or of course that you may plan to have. They do eat, apparently, so it's something that banks do need to factor in. A single person just looking after their own expenses is obviously going to be a totally different scenario to a couple with, say, 3 children. The amount of deposit that you have saved is vitally important. It's probably one of the most important things, one of the first questions we ask, because that helps us work out which lenders are going to be appropriate. Some lenders are okay with a very small deposit. Some require at least a 10% deposit. So we'll come to a few scenarios on exactly what that means just at the end of the half-hour presentation. And family guarantors also, if you're lucky enough to have a family member who's prepared to go guarantor, it can make a huge difference to the type of loan that you might go for and the amount that you may be able to borrow as well. But that's something you obviously need to have that discussion with your family about. So again, it just comes back to what do you feel comfortable with. So we prefer, before we tell you what you are able to borrow, we prefer that you've done your own little budget and spreadsheet and work out what you feel comfortable with borrowing, because there are many, many times where the banks will allow you to borrow a lot more than what you feel comfortable with, and at the end of the day, you're the ones who have to pay the thing back. Just to give you a bit of an idea of what those numbers mean, putting that into perspective, a comparison of 2 different couples. Couple A earning a combined income of $100,000 gross per annum. We're assuming that that's split evenly, so $50,000 gross per annum each. No dependent children, no other existing debts. We've taken a current selection of 7 of our lenders just to give you a little bit of an idea about the I suppose the variation that there is in lender policies. One thing that it's useful to point out is that there may not seem to be a lot of difference with interest rates or even products with a lot of the lenders, but there is an enormous difference with their policies. So that's really, I suppose, where our expertise comes in. And we can certainly point you in the direction of a loan that will have a far better chance of being approved. So on this scenario, if you can see a couple, again, earning $50,000 a year each, no dependent children, no existing debts. If you happen to go into lender number 6 that we have there, showing that they would allow you to borrow just under $460,000, but ideally you wanted to borrow over $600,000, your loan with lender 6 would be declined. And you may or may not know why. Lenders actually don't have to disclose, whereas we would know their policies and know that we would not put an application to lender number 6 if that was the criteria that we had. If you wanted to borrow $640,000, then the only one of those lenders that would be able to do that would be lender number 7. So it makes a huge difference, as you can see. The variation between the 460 and the 640 is quite substantial. If we then look, if we then look at couple B, same income. So again, looking at $100,000 combined income, $50,000 per annum each, but now 2 dependent children and just a credit card with a limit of $5,000. You can see that that makes quite a substantial difference in terms of the amount that you'd be able to borrow, for obvious reasons. Those children do eat. But the important thing there is it's not actually the same lender that would allow you to borrow the most. So just because you might have gone with lender number 7 in the first instance doesn't necessarily mean that lender number 7 will be the best when they look at that particular policy and that particular scenario. So again, we would be able to help you with all of that and understand, based on your own situation, who is going to be the best lender. So I can see that pretty well everybody has now joined us, which is great. So just to go, I suppose, to the next step, which is choosing the right loan and the loan and the lender that is right for you in your particular circumstance. So again, even before you get to a pre-approval, what is it that you want from your loan? I'm sure you've all had conversations with friends and family members who say, oh, we should do it this way, and you should have an offset, and you should have a redraw, and you should fix half of it. All those sorts of things are great, but remember your own situation is specific only to you. So what is it that you want from your loan? And which lender can offer the best deal at the time. Again, that's where our expertise, dealing with about 25 lenders at any one time, that's where we can really help work out, once you know roughly what you want, what your maximum purchase price is likely to be, what the features of the loan are that you're after, we can certainly look for the one that best fits that and offers you the best deal at the time. And there are some pretty attractive deals out there at the moment, some of which only last for a few weeks at any one time, and they're not always advertised very well, if at all, by the lenders. So the banks generally won't actually let you know perhaps what their best deals are at the time, or how much they can actually squeeze the interest rate for you. You do need to find out, or we do need to help you find out, if you meet the lender's criteria. It's all very well going for a particular loan that might have you know, a 0.1% lower interest rate, but if that particular lender won't approve the loan, then what's the point in applying for that one? So we will make sure that you fit the lender's criteria and you don't end up applying for a loan that then gets declined, because that doesn't do you any good whatsoever, having that that showing on your credit history. It's really important to try to protect your credit history. You may also want to consider fixing all or part of your loan, and that's something we can help you look at, you know, who's going to be best to do a bit of a mix and match scenario, if that's the sort of loan that's appealing to you. I really won't focus on the fixed rate loans because more often than not, if first home buyers are looking at getting a pre-approval before they apply for a formal approval, you'd generally be looking at variable rate loans. You can always go from a variable rate loan to a fixed rate loan pretty well at any time you choose, but once you're in a fixed rate, it's very, very difficult and can be very expensive to get out of it. So essentially, if we just focus for a couple of minutes on variable rate loans, there's two main types of variable rate loans. Your basic variable loans tend to have a reasonably low interest rate. So if the standard variable rate with most of the banks is around 7.5, 7.6 at the moment, you'll find that most of the basic variable loans are hovering around, say, 7%. And often they have quite a low fee structure. They don't have a lot of bells and whistles. So what happens with a basic variable rate loan? You may have a loan, home loan of say $300,000. You will be paying interest on that full $300,000 loan. You will then have a savings account where you make the repayments from. You generally set up a direct debit for the payments to come out of every fortnight or every month of your choosing. Generally matches what your cash flow is. If you get paid weekly, you might make your repayments weekly. If you make extra repayments, so say you get a lump sum payment of $10,000, you decide to pay that into the home loan. 3 months down the track, you might think, great, I now want to renovate the kitchen, and you can then redraw those funds. So essentially you can make extra repayments, generally unlimited with a basic variable loan, and you can redraw extra payments as well. However, any money that's sitting in your savings account is not really having an impact, or is definitely not having an impact on the amount of interest that you're paying on your loan. 100% offset accounts. I might ask a question here because I can see that we've had a couple more people join as well. Who has actually heard of 100% offset? Hands up possibly? Great. Awesome. Okay, so a couple. So 100% offset is something that's really appealing to a lot of our clients, particularly when you're hoping that you can pay the loan back a lot faster and a lot earlier than the normal, say, 30-year loan term. So essentially how it works, offset is unusually quite a good term. This industry is full of really, really bad terms and bad terminology that often doesn't make sense, but it does offset. So for argument's sake, if you had $10,000 sitting in your savings account, which is linked then as an offset savings account, and again your loan might be a $300,000 loan, you're only then paying interest over and above what is sitting in the offset account. So if this was $10,000, your home loan was $300,000, you'd only be paying interest on the $290,000. So really what that means is that $10,000 that's sitting there is essentially like, let's say you were paying 7% on the home loan. It means essentially that that $10,000 is earning you 7% per annum, whereas a high interest earning account at the moment might get you, say, 5.5%. But the real beauty of it is that you don't then pay interest on that. So even if you had your savings in a high interest earning account earning 5.5%, you would then pay tax on that interest that you earned, whereas when it's in an offset account linked to your home loan, you don't pay tax on it because it's actually it's an intrinsic part of the home loan package. So a lot of people love that idea. Some people, however, find that having their money in an offset account, which also tends to act as your day-to-day savings account, sometimes is a little bit too accessible for people, and they find that they don't quite have the discipline required to keep a reasonable buffer in that account. So it is, as they say, horses for courses. This will suit some people, it won't suit other people. So once you've ascertained what your own budget is, what you're comfortable with borrowing, roughly in your own mind what sort of purchase price you're going to aim for, the next step is really to come to us and organise a pre-approval. So this is really just a preliminary home loan approval. The banks and lenders at this stage don't know anything about the property that you're buying. All they know is what's presented to them and what we present to them when we're telling your story. We don't simply put in a loan application, we do present your story to them. Nothing is vanilla these days, and we do need to add a little bit of a story to help the lenders make their decision nice and easily and come back as approved as quickly for you as possible. A preliminary home loan approval, pre-approvals at the moment with lenders are taking, look, let's say allow a week. It can be a little bit faster or a little bit slower than that, but let's say in general it's a week. Once you have that, you can really start actively looking for properties. So making offers, even bidding at an auction is absolutely fine. The pre-approvals are generally only valid for 3 months, sometimes 6 months, but generally only 3 months. Might be worthwhile asking at this stage, has anyone actually been to an auction? Hands up for that one. Anyone been attending an auction? Great. Oh, awesome. Lots of people. Good. They can be a bit scary, particularly for first home buyers. I know a lot of our first home buyer clients get really stressed by auctions. I grew up in Melbourne, so auctions are just, you know, part of the day-to-day way of buying property down there. But in Sydney, they're a little bit, I suppose, less frequent, particularly for first home buyers. But if a property is going for auction, don't be scared about it. Just talk to us beforehand and make sure that you've done all your due diligence before the auction. So I suppose that's the difference between buying something, what they call private treaty, or buying something at auction. If it's private treaty, you make your offer, you have the time, generally cooling off period, to organise all that due diligence, to have your contract reviewed by your solicitor, and to have the bank do all their final searches and the formal approval for the loan. At the auction, the only difference is you need to do all of that beforehand. So you do end up spending a little bit more time and possibly, unfortunately, some money as well getting all those searches done. But given that there is no cooling off period, you really do need to do all that due diligence. You don't want to find out after you've bought the property at auction that the reason you got it for such a bargain was because there's a $50,000 levy that's just been raised and you have to pay for it in 6 months. So that's the sort of thing that unless you do your due diligence, you could very well find that out. So once you've got your pre-approval under your belt and you can go out actively looking at properties, I really recommend engaging a solicitor or conveyancer at that time. Don't wait until you've found a property on a Saturday afternoon and you're in a bit of a panic about the whole thing. Make sure that you've worked out who it is that you're going to use as your solicitor or conveyancer beforehand, so that if they do get a panic phone call from you, they know who you are. It can be very, very frustrating if you haven't done that previously. Once you've got the pre-approval, you've worked out who you're going to use as your solicitor or conveyancer, then it's up to you to go out there and find a property. And good luck with that. I mean, I've had this business for almost 15 years, and some people have taken quite a number of years to actually find a property. Things happen. We understand that things happen. People get relocated for work. People get married. People have kids. All these things end up meaning that you might lose focus for a while. First homeowner grants come and go and they change as well, so that can stimulate or not the environment that we're in as well. So in other cases, we have people who come to us one day and then, the very next day they put an offer in on a property that's been accepted. So as I say, good luck finding the property. There's really no one else who can help you do that. It's just a lot of foot slog. The internet is a great tool for looking for property, but it doesn't beat going around and doing those property inspections personally. You then negotiate a price, so assuming it's not an auction that you're going to, again, negotiating the price is really up to you. There's no one who can help you with that. There was some research I was looking at a couple of weeks ago that said that these days advertised prices or properties are selling roughly between 5 and 7% under the initially advertised price. But that's so dependent on what the vendor is expecting and how greedy or how needy they actually are to get that property sold. Do all your pre-purchase or pre-exchange inspections. Your solicitor or conveyancer will organise all of that for you. So strata searches, building inspections, looking at council searches, all those sorts of things. So you would generally leave that in the hands of your solicitor or conveyancer. So while they're doing all of their work, what we need to help you with your finance approval is just the front page of the contract of sale and to know what the price is that you've negotiated on. So assume then that you have your pre-approval. We then take that to formal approval. So unconditional approval. At that point in time, hopefully the property that you've purchased is certainly no greater, quite possibly a little bit less than your pre-approval is for. We would then run through those figures again with you. It may be that you have a little bit more deposit now. It may be that you've had a pay rise. So we certainly don't assume that the pre-approval amount or the pre-approval conditions are the same as they were when you initially did the loan application with us. There may be some outstanding conditions that need to be satisfied. I was speaking with a client this morning whose pre-approval we only got last week. He's now found a property. The purchase price was $3,000 less than what he was pre-approved for, so we just slightly rejigged those numbers. But importantly for him, one of the conditions of his pre-approval last week was that he needed to pay out a small amount that he still had left owing on a car loan. As that was, in the eyes of the bank, that was impacting on what he was able to borrow for buying his home. So he's now provided us with a statement from the personal loan provider showing that he's now paid that out. So we can now go ahead to formal approval for him. The bank will be carrying out a valuation on that property that he's now had an offer accepted on. Once the bank has done the valuation, they've ticked off to make sure that all of those outstanding conditions have been satisfied. We then get a final approval that's usually emailed through to us, and that's the point in time where you can sign the property contract and exchange, meaning you hand over your 10% deposit and it's a done deal essentially. There's no turning back after that point in time, or if you do, you risk losing the 10% deposit. Once you've actually done that, you can take a deep breath. The really stressful part tends to be once you've found a property and you're waiting for the period in between the pre-approval and the formal finance approval. It is a very stressful time, and that's why it's important to have a really good team around you. So your solicitor or conveyancer and obviously your mortgage broker, hopefully that's us, working with you to make sure that everything goes as smoothly as possible and everybody's kept in the loop all the way through that particularly stressful time. So with regards to signing your mortgage documents or the part between exchange and settlement, it's fairly relaxed. It's usually 42 days. It's essentially just a lot of paperwork from the bank to your solicitor to you and back to the bank again. So the loan agreement is essentially checking to make sure that the terms and conditions of the loan that the bank is offering you is the same as what we said it was going to be. Banks are human. They do make mistakes, so it's always worthwhile just checking through that with us to make sure it meets your original requirements. The mortgage document generally comes out with the loan agreement, and that's, I suppose, the official document which gives the bank the right to take ownership, if you like, or the title deeds over the property. If it's something to do with the mortgage document that you have a query about, you should refer to your solicitor or conveyancer for help with that. Those documents all need to be fully executed and returned at least 10 days before settlement. Particularly, at this time of year leading up to Christmas, it does get a little bit crazy there, particularly with what's happening with the first home buyers. And the stamp duty concessions. There's a lot of activity out there at the moment, and the banks are already starting to slow down with the pre-Christmas rush. First homeowners grant, just looking at the time as well, we started ever so fractionally late, so I probably will run a little bit over time, and I'm just hoping the clock doesn't time out on me. So again, if it does, we have all of your details, so we'll get in touch with you via email. But yeah, probably about another 3 or so minutes to go. First homeowners grant, there are 2 parts to it. So with regard to the federal government initiative, that's not changing. That one-off $7,000 cash grant will still be available. It's been around since July 2000 in one way, shape or form. There's no talk that it's going to disappear. At the moment, it's $7,000 cash grant for any property less than $835,000. I might just make sure that we're all still there. Is everybody who's looking for a property at the moment looking for a property under $835,000? Hands up if you are. Yep, suspected so. So that's great. The $7,000 cash grant is not means tested, and it is tax-free. And of course you must be eligible. The Office of State Revenue has a really good website, and we can quite simply tell you what the eligibility criteria is. But in a nutshell, you must be over the age of 18, permanent resident or Australian citizen, or at least one person must be a permanent resident or Australian citizen, and obviously never have owned property in Australia before, either on your own or with anybody else. It's not available for investment purposes. So if your intention is really to buy an investment property, thinking you can get away with the first homeowners grant, no, you can't. Clients of ours tell us that they do audit, that they do door knock, they do send people to check to make sure that you are in the property using it as your principal place of residence. You do only need to do that for a continuous period of 6 months, so it's not onerous. So the part of the first homeowners grant that is disappearing at the 31st of December is the First Home Plus, the New South Wales concessions. So it was for properties up to $500,000 that you had a full exemption of stamp duty. This must, to still qualify for that, the contracts must be exchanged before the 31st of December. You don't need to have settled before then. That would just be way too fast. So in terms of exchanging, it just means you need to have a signed, fully executed contract. You may not settle on that property until February or March, as long as you've exchanged before the 31st of December. I won't talk about the new home scheme at this point in time because it's probably not relevant for a lot of people in this area, but if you are interested in that, have a look at the Office of State Revenue website, which we've listed down there as well. So those savings again, at the moment, First Home Plus savings, as you can see, a property $500,000 value or a contract price of $500,000. The normal stamp duty, if you're not a first home buyer or if you're not able to do this before the 31st of December, is basically $18,000. As a first home buyer, it's $0. So in terms of the savings, it's pretty enormous. To think how long it might take someone to save that amount of money, particularly if you're having to pay rent. It could be a long, long time before you're able to, to be in a position to cover the $18,000 as well. There are still concessions available for between $500,000 and $600,000 as well. So if you were buying something for, say, $550,000, the stamp duty concession, or the savings you'd have would be about $9,000. You would only have to pay about $11,000. So it's still a decent concession. Over and above $600,000, no concessions whatsoever. Just a couple more slides, so maybe another minute or two at the most. So just to give you a bit of an idea of what those numbers all mean, putting this into perspective, if you were buying a property for $500,000, the property stamp duty normally would be about 18 grand, allowing for the other costs. We say allow about $2,500 for legals, which should well and truly more than cover the cost of your solicitor and all the searches that you need to do. There may or may not be application fees depending on which loan you're looking at. Registration fees, they're government registration fees, nothing you can do to avoid those ones. So really a $500,000 property has a true cost of more like $521,000. So let's say you wanted to borrow 90% of the value of the property, so 90% LVR. You would therefore need to contribute just under $79,000 yourself. LMI here, lender's mortgage insurance, is an unfortunate cost. I call it a necessary evil, that the banks have invented this great way of getting fees from people who borrow more than 80% of the value of the property. So if you don't have a 20% deposit, which very few first-time buyers do for obvious reasons, then unfortunately the way to enter the market is to pay that mortgage insurance, and in this case it would be about $7,500. So that first scenario you would need about $79,000 if you were to borrow 90% of the value of the property. As a first home buyer that's still eligible before the 31st of December and the stamp duty concessions disappear, the true cost really is only the cost of the purchase price plus your legal fees and any application fee that there may be. So in that scenario you would only need about $54,000. You'd still end up borrowing about $450,000. And the other thing that can make a little bit of difference that makes your contribution even less, some lenders will allow you to add the lender's mortgage insurance to the loan. So that $7,500, rather than you paying for it up front, you can actually add it to the loan. So you're effectively making your loan $457,500. So at that level you only need to contribute about $46,000. So that's probably way too many numbers to have on one slide, and essentially that was really where we were going to end. So in terms of any questions that people had about that, as I said, we will be emailing each of you, so if you do have any specific questions that we can't address this evening, please feel free to email me in the next couple of days and I'll get back to you. But in the meantime, were there any particular questions which I should be able to see on my screen coming up? They're very hard to read, but yes, I can see. I think I'll just tackle one of those. I can see there's 2 or 3 there. But in terms of what is the minimum amount of deposit that you need, I know that example I had there showed basically a 10% deposit. There are still lenders out there that will allow you to borrow up to an absolute maximum of 97% of the value of the property. But of course the cost of things like mortgage insurance goes up quite substantially at that level. But it is possible. So if you have a much lower, if those deposit figures were a little bit daunting, if you have a much lower deposit than that, it doesn't mean you can't do it. It just means that you may have a much higher cost of mortgage insurance, or potentially we could possibly look at whether a family member could help go guarantor. So I think we might leave it there. I don't think we ran too over. So thank you very much for your time, and as I said, please feel free to email any specific queries to my email address, which is on your screen. And thank you very much for your time.